Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We have just released a monthly India market outlook titled Resilience or Irrational Exuberance. In today's podcast, we summarize our macro and key asset class views. Before we get started, a quick roundup of the past month. Indian assets maintained its outperformance over global peers amid improving domestic macro fundamentals, strong corporate earnings delivery, and a resumption in foreign investor inflows into equities. Over the last month, the Nifty index rose 2.4%, outperforming the MSCI World, which fell 0.4%, and MSCI Asia Japan, which fell 0.9%. The INR depreciated by 1% against the US dollar, while the benchmark 10-year Indian government bond yield fell by 11 basis points to 6.98%. Now, this performance of Indian assets seemed to be a departure from the trends we've observed in performance from October 2022 till about mid of March 2023 on the back of stretched valuation premiums, both absolute and relative to peers. In our view, superior macro fundamentals relative to peers, likely pause in RBI's rate hiking cycle, and robust corporate earnings cycle are likely to drive resilience of Indian assets amid a still challenging global macro backdrop. Nevertheless, we believe volatility is likely to remain high as weakening global growth outlook, elevated inflation, and tighter lending conditions is likely to impact demand and corporate profitability. We thus maintain a diversified asset class outlook given a view of a balanced risk reward across major asset classes. In our assessment, our safe strategy, which we highlighted at the start of the year, is still a prudent way to navigate 2023. S is for secure your yield, A is for allocate to long-term value, F is for fortify against future surprises, and E for expand beyond the traditional. Moving on to macro and key asset class views, we expect India's economic growth to track above its long-term trend and ahead of its major peers in 2023. The recent quarterly GDP growth data published for the fourth quarter of fiscal year 2023 surprised markets on the upside and led to positive revisions for fiscal year 2024. Supportive government policies, sustained revival in services, and a pickup in private capex are tailwinds for growth. Further, a likely peak in RBI's policy rate could drive a pickup in consumption demand. In our view, the CPI inflation is likely to trend lower in 2023, tracking within the RBI's medium-term target range of 2% to 6%, given a high base effect, easing commodity prices, and the lagged impact of monetary policy tightening. Key risk, however, to a macro outlook, global growth slowdown, persistent high inflation, and escalating geopolitical tensions. On key asset class views, we have a neutral stance in Indian equities. Higher than average valuation premiums, both absolute and relative to peers, is counterbalanced by robust domestic growth and resilient earnings growth expectations. The Nifty index registered an earnings growth of 11% for fiscal year 2023, while the expectations for fiscal year 24 and 25 are estimated at 17% and 16% respectively. Within equities, we maintain our overweight on large cap equities given relatively better macro fundamentals and a greater margin of safety, both in terms of earnings and valuations compared to mid cap and small cap equities. On sectors, we are overweight domestic sectors given a weak global macroeconomic backdrop and greater earnings resilience, and accordingly retain our overweight on financials, industrials, and consumer staples. On bonds, we continue to maintain a neutral stance as attractive absolute and real yields are counterbalanced by below average yield premiums, stretched medium-term fiscal position, and weak government and bond demand supply balance. The RBI's recent pause on policy rates is a tailwind for bonds. Within bonds, we are overweight short maturity bonds given an attractive carry. In our assessment, government bonds and high-quality AAA corporate bonds offer a better risk reward as tight financial conditions are likely to persist. In addition, India's bond real yields net of inflation are higher compared to other emerging market peers. Yield premiums, which is the spread between the 10-year Indian government bond yield and the policy repo rate, has moderated and is trading below average. In our view, the RBI's decision to keep the policy rates unchanged in the latest monetary policy indicates the likelihood of bond yields being closer to the peak. We expect the 10-year Indian government bond yield could trade in the range of 7 to 7.25%. Cash remains a neutral holding, and finally gold remains a neutral holding and a portfolio hedge against elevated inflation and equity market volatility. That's it in this edition. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.